Hey, Market Chameleons, thanks for joining us. And there's the main chameleon, Dmitry Pargamanik. Hey,
Good
D, what's
morning,
cooking?
everyone. Good morning, Will. Good morning, everyone.
How you doing, buddy?
Pretty good. Pretty good. We're just looking at some of the movers to talk about this morning.
Yeah, it's always great. It's always great having getting started and watching the commentary back and forth. Brian was bringing it this morning. There's a lot of interest in commentary which helps us think about maybe things to talk about, to see. But let's start with the disclaimer. How about that?
Yeah, let's get that out of the way. So here you go, guys. This is the disclaimer I was about to bring up. Keep in mind, we are not registered investment advisors or broker dealers. We're not telling you what to do. We're not making recommendations. We're just sharing ideas. If you need a professional to help, then seek a registered investment advisor or talk to your broker. So there you have it. I'm going to come back in and share the screen. Let's do that. And a couple of things of note today. I think the Fed, there'll be FOMC meeting a little bit in the afternoon. We have Google, Facebook, Apple in a hot seat, right, Will, in Congress?
Yeah, they're going to be speaking in front of the big guys today, which is always interesting and always can lead to maybe some market activity. Is interesting.
Exactly. And then we got the GDP numbers tomorrow. So a couple of things to look out for today. And as usual, I'm just going to start out with the pre-market report, look at a couple of things that are moving in the pre-market. We'll talk about some earnings, maybe look at some earnings trade ideas if we have time, and then leave some time for questions. So
yeah, while you're mentioning questions, D, let's make sure everybody, if you have a question for Dmitry or myself, please put it in the chat. We're on YouTube Live. If you do have to come over because your screen is fuzzy, I put out the link to the Zoom, which is the process and application, and put it in the chat there. Other than that, just remember to like us and subscribe to our Facebook channel. I mean, our YouTube channel. It's a big deal. All right, Dima, let's start that pre-market report.
Thanks, Will. So if it's the first time you're looking at it, this is the pre-market report. And basically it's stocks that are trading in the pre-market before the market opens at 9:30. We have it here, the most active, the top percentage gainers and top percentage decliners. And we're going to go in, and usually I just start at the largest gainers and whatever pops up at the top. So today it's Kodak. I think that's the second day in a row that it's on the top of the list, and they're rallying on that government contract. Then we'll go into SNOA. I think that's the next one on the list. 84. That's up 84% in a pre-market on 1.4 million shares trading hands in a pre-market. And over here, see, that's the volume, 1.5 million. It has a small float of 2 million shares. Again, this is a very small cap stock, very liquid, but a lot of people like to play those small cap stocks that move a lot. They like volatility and movement. So we'll just take a look really quickly at, there's some news here. I think I saw some news here today on some potential disinfectant sanitizer for airline. Didn't get too much into that catalyst move. You could read more about it, but this is how the stock's reacting in the morning. Here I'm just seeing that the VWAP bar, the biggest bulk of it is 256,000 shares traded hands between $11.89 to $12.23. That's where it closed, 646. You see here, this is the 52-week range, so it's still within that 52-week range, but right now in the pre-market, it's trading 1169. That's up 81%. I'm gonna really quickly.
While you're on that stock, D, someone was asking, can we look at the historical, if it's had gaps like this before, what it's done?
Yeah, so that's what and that's a good question. Right. So that's what I'm just going to do next and say, well, historically, how did this stock tend to behave after such a large gap move? So that's awesome. Up here, the gap up history. So let's just take a look. So this is the largest 12 gap moves in the last 3 years. So we could see here that the average of them was 24.3. Today it's 81%. We also see here that just May 29th was up 142% at the open. And it seems like that there's also press release there, again, something about the disinfectant and sanitizer, that maybe they're getting contracts. I didn't read the whole story behind that, but those are the catalyst moves. If you want to see, just hover over them over here. But here it gapped up 142%. After the open, it continued that rally. So from the open to the high, it looks like it gained 49%. But by the end of the day, it gave all that back. And actually from the opening price, it drifted lower, minus 26%. So this is how it tended to behave after large gap move from the opening price to the closing price. 83% of the time it closed lower for an average of 8.9% loss. From the opening to the high of the day, it averaged 7.9% gains. From the open to the low, it averaged negative 12.2%. Here we see that that 58% of the time it went higher from that opening price, which is saying that, right, 42% of the time, see here is zeros, that opening price was the high of the day. So it opened, that was the high of the day, and after that it drifted lower. So that's, keep in mind here, going out after the opening, after large gap move, going out 1 day, 2 day, 3 day, you could kind of see that those days have been weaker, and it gave, on average, it gave back, a couple percent, 5%, 2 days after, on average, 92% of the time declined. That's really quickly a synopsis. Again, you want to go still read what the catalyst is, what's behind it, and kind of also put that into your decision-making process. I'm going to come up to, let's open up Kodak here. That's the second day in a row that it's up. So it's up 83%. Again, that's reacting to news. They're getting some government contract here, after announcing the deal. Still small cap stock. Today, pre-market traded 19 million shares, a little bit over 19 million. That compares to a total float out there of 12 million shares. So a lot of volume in that stock. Here's the two bars that stick out. A lot of volume traded, 4.3 million between 12.88 and $13.20, and then up here 14.81 to $15.13. Let's take a look. I know it gapped up yesterday. Let's see what happened yesterday. So this is yesterday's move, July 28th. It was up 271% at the open. From the open to the high, it gained another 21%. From the open to the low, it lost 38.4%. But by the end of the day, from the opening price to the closing price, it was down 18.5%. This is how Kodak tended to do historically after large opening gap moves. So these are the 12 largest gap moves in the last 3 years. They averaged 36%. We see it today. It's a lot more. And keep in mind, there's a catalyst move here. So here, this is telling us historically when it gapped up a lot. By the close, it drifted lower. All 12 times out of these 12 observations, for an average loss of 6.7%. From the opening to the high, it averaged 4.1%. From the opening to the low, it averaged negative 10.7%. As we could see here, that at least 4 out of these 12 observations, that opening price was the high of the day. So that's a really quick Kodak historical gap. I'm going to go, before we move on to earnings, I'm just going to go down here and look at how these gappers performed on average in the last 2 weeks. So here we see that if we took in the last 2 weeks, stocks that gapped up in the morning, right? This is our control group. If we took all the stocks that gapped up in the morning, 51% of them added from the opening price by 10 a.m. By the close, 48% were lower. By the close, 43% of them were up from the opening price, 56% were lower from the opening price. So if you did every stock that gapped up in the morning, 43% by the end of the day were higher, 56% lower, for an average loss of negative 0.4%. And let's compare that to gap down moves, like what happened instead of the gap up moves. Let's look at gap down moves, what tended to happen. So I'm going to switch this over here. So we see stocks that gap lower, 47% of them by 10 a.m. were higher, 52% were lower from that opening price, for an average loss of negative 0.5%. But by the end of the day, 52% of them from that opening price were higher, 47% lower, for an average gain of 0.1%. So if you just compare the gap ups versus gap downs, you're, at least in the last 2 weeks, you're better off buying the ones that gap lower than the ones that gapped up higher. So what I'm going to do here is, since this is our control group, I'm going to filter out a little bit, and I was playing around with it in the morning. I'm like, well, what if you stuck with the higher cap stocks that gap lower? The idea is that maybe the higher cap stocks that gap lower were the ones that people, the quality ones were the ones people came after. So I'm going to just see, like, what about stocks that are over 50 billion market cap? So we could see here that the ones, if we just filtered 50 billion market cap, those did better. So the whole group, 47% of them were up. The ones that gapped down, 47% of them moved up by 10 a.m. If you only stuck with the 50 billion market cap or higher, 53% of those were higher. So a little bit of an improvement. By the end of the day, we see that the control group, 52% of them were higher by the end of the day from the opening price, versus our filter group, 58% of those were higher by the end of the day, for an average of 0.2% gain versus 0.1%. So what else I did was, well, what about if we took the 50 billion, just looked at earnings, and the ones that just reacted to earnings? So here I'm going to filter out has earnings. So you see here, that group, the ones that actually were down on earnings, only 36% of those gained from the, so what this is telling me is that if there was an earnings catalyst and they were down, usually they didn't recover, right? Only 36% of them were higher by the end of the day, for an average loss of 0.8%. So of course, maybe even taking out the earnings would improve that, would even improve that more. So we could see here, these are the ones that reported earnings. These were, down at the opening price. By the end of the day, from the opening price, a lot of them, continued lower. So that's really quickly just comparing a filter group versus a control group. Let's go see what's been reporting earnings in the morning. Really quickly, this is the earnings calendar. I'm going to just filter out things that are reporting before the market open. So we see here.
D, you did that drop down really quick. Someone just asked how you did that. Could you
to the earnings?
Yeah, before the market, before the market, what you where you clicked to see what trade.
Oh, before market. Okay,
yeah.
So see time of day over here.
Yeah.
So I just switched to stocks that are reporting before the market opens.
Gotcha.
So that's,
so everyone knows, the acronym BMO obviously means before the market
opens, right?
Yeah.
So the idea is that, they're probably already reported because it's 9 o'clock, or we're anticipating that they're going to report, before 9:30. The other things, also keep in mind that sometimes they'll report before earnings, but they'll also have a conference call, like over here, Boeing at 10:30 a.m. They could say something on that conference call that could, further make an impact on that stock. So you want to keep that in mind, that sometimes you'll receive top numbers, but here's one 10 a.m., 11 a.m. If the management is talking during market hours, that can make the stock move. It could even make it reverse from its original reaction. So that plays a big part into how investors react to it. I'm just going to scan really quickly and look at the movements here. We see SNY up top, that's up 1.5%. That's compared to an expected move of 5.6% in either direction. So this expected move, it's looking at a percent move up or down based on the option straddle. Here's that's Shopify. That's up 11.2% in the pre-market right now. That's compared to an expected move of 8.1% up or down in either direction. Boeing right now up 0.7%, 0.75%. That's compared to a 6.2% expected move. Here we go. Anthem up, down, almost unchanged. That was expecting 4.3% move, and so on. GE over here up 1.5%. I'm just going to compare this to how they fared versus the 12-quarter average move. So yesterday we see here the expected move. This was the expected move coming in yesterday. So we see here that this compared to the 12-quarter average, this one was up. This was 3.2% above its 12-quarter actual average moves. This was up 1.4% above its actual 4-quarter average moves, and this was up 2.7% above its 4-quarter average move. These were the max moves in the last 12 quarters. Boeing, Anthem, Shopify, SNY. That's not including what it will move today. If you're okay, I'm going to go see what's coming up for earnings.
Yep.
Let's do that. So we are in earnings season right now. What I'm going to do now is just filter out in the next 2 weeks. Let's look for the higher cap stocks, that trade at least 5,000 option contracts a day on average, with market cap of over 200 billion. So these are just I'm filtering out the higher cap stocks that are expected to come up with earnings. So we see here PayPal, MasterCard, PG, Comcast, Apple, Amazon, Google, Facebook. Of course, these are all also up on right now testifying in front of Congress. So we'll see if that impacts the stock prices. Merck, Disney, all coming up with earnings. Let's take a look at, here's PayPal. That's expected today after the market close. Right now, based on yesterday's closing price, options are predicting a 6.5% move in either direction, up or down. That compares to a 4-quarter average actual move of 7%. So we see that's 0.5% below that average, and 12-quarter average move of 5.4%. So we can see here that's yesterday's expected move is 1.1% above that 12-quarter average. In the last 12 quarters, that high move was 14%, low 0.4. That's PayPal. Let's take a look at, here's Amazon. Amazon is expecting report earnings tomorrow after the market close. Yesterday's straddle closed. Its expected move is up or down 6.1%. Let's compare that to the 4-quarter average of actual moves of 4.4%. So now that's estimating 1.7% above that. 12-quarter actual average move of 4.7%. So that's 1.4% above that 12-quarter average. In the last 12 quarters, the high move is 13.2, low move of 0.5. Facebook, 6.4% anticipated move up or down. That's compared to a 4-quarter average move, actual move of 3.8%, and 12-quarter average move of 6%. And here we see that that's kind of a little bit slightly above where the straddle is usually priced. Last 4-quarter average implied going into the earnings, the options were implying 6.1% move versus today's 6.4. 12-quarter average 6% versus today's 6.4. So that's really quickly just going through what's coming up, earnings, what was moving today, a couple catalysts that, news that we talked about was, Congress, the Fed FOMC meeting today, GDP numbers tomorrow, things to look out for. We'll just just so we have time for questions, if you see any, let me know.
Yeah, there's some. This is a small cap stock, but they do trade options. Someone's asking about Zynga, and if you could maybe go over the option strategy outcomes around earnings.
Is that it?
That's one of them. The other was you know, someone wanted to look at the SPY, the skew, the implied vol. You know, maybe take a look at that.
Okay.
That was
Okay. So this one is Zynga.
Zynga, yeah.
Okay, so let's just take a look at.
Yep.
Huh?
Nope, that's good. Zynga's it.
All right, let's do this one first, and then we'll get to SPY. So over here, this is how in the last 12 quarters, these long bars over here, that's what the markets were anticipating, up or down. That's why you're seeing up or down. And then the green bars is the actual move, and the red bars are the actual move. So when you see them break through, that means the actual move, like in this case, was 13.2% versus an anticipated move of 10.7%. So this one kind of moved more than the expected move. When you see them within the range, like over here, the actual move was negative 3.9% versus an anticipated move of plus or minus 10.6%. So you see that the move was more muted than the anticipated. Let's just see from a straddle perspective. We see here that that the options market, they overestimated the move 85% of the time. So 85% of the time, that straddle was overestimating the move, and the average implied move in the last 12 quarters was 9.6% versus an average actual move of 4.6%. So you could see that there was, big 5% differential here. Of course, the fear is if it's a small cap stock or whatever, one of these days it can move a lot. So from the long straddle, that was only a winner 9% of the time. And for an average loss of 48%. In other words, like if you bought that straddle, on average, you lost 48% of the premium the next day, if you got out. From the long strangle, where you're buying out of the money put, out of the money call, that had a 0% win rate so far, with an average loss in premium of 80%. Let's just take a look here at the implied volatilities and what they tended to do. So here we see that using the 30-day constant maturity, so it's like a 30-day expiration option, on average, the volatility declined 31% the day after, from the day before to the day after earnings. So here's 31%. So on average, day before, implied volatility was 53.5. Remember, this is the 30-day constant maturity, not the near-term 30-day constant maturity. On average, 53.5 the day before, the day after, 36.5, 5 days after, 33.3. So we could see here, this is on average the day before, 53.5, high of 67.1, low 42.3. Day after earnings, 36.5, high of 47.7, low 27.5. That's the last 12 quarters statistics. Coming out, it looks like it tended to decline a little bit more day after, after earnings, kind of moving 1 day, 2 day, 3 day, just declined a little bit more, maybe as much as like 10%, which we see here, something like 7-8%. So that's from the perspective of Zynga. What was the other one, Will, that you mentioned?
We commented today that all the big tech companies are speaking in front of the big boys in Washington today. Yep. And there seems to be a lot of discussion about the next stimulus package, which everyone thought, I think, was a no-brainer. It's really there are two sides to one party that are, digging their feet into the sand about getting this done. So there's some things out there in the short to medium term. you know, and then going out towards the elections and everything else. They
Right.
just want to look at the SPY.
Yeah.
They were asking about the skew and the volatility. So whatever you see.
Okay. Right. And with that stimulus package, the idea is like they're pumping out more and more money into the economy. I think this one's 1 trillion on top of like whatever trillions we had before, plus the Fed, you know, is pumping money out. That's creating inflationary pressures, especially in a unusual period like this where our productivity is halted. So I think a lot of people looking at that inflation are playing the, you know, we talked about the silver, right? The silver trade, gold trade.
Speaking of that silver trade, D, not to jump too far ahead, but Chris Marcus, everyone who we had on, I don't know, maybe a month and a half ago, but he's been making a call on silver for a while now. And he still thinks there's a lot of interesting things that could happen. So he's going to be back on. We thought it was worth bringing him back on as soon as possible to talk about it. So he'll be on Monday. We're doing a webinar on Monday, 6 p.m. So
yeah, and this is what I know. I think we went over silver yesterday pre-market. So this is again, like I'm looking at silver, and as you can see, it didn't really make a big move yesterday. It was kind of unchanged, but the implied volatility continues to go higher. So you see all the way out to here, a lot of volume in the options, which at least the people playing in there think that it's still going to be, that it's going to make a big move, right? They're pumping up those implied volatilities. So that inflation, like look here, you know, look, here's July 31st. So this is only 3 days to go, but look at all the volume here going up. You know, up here 12%, 9%. You see a lot of options trading. So look, one thing we keep talking about is watch, you know, those commodities. If inflation fears kick in, they start moving, they accelerate, right? It's like the opposite of a stock. They could accelerate to the upside on the inflation fears. But having said that, let's just go to the SPY. Go ahead.
Yep.
See. So this is the SPY here. Kind of, what was there a specific question on the SPY?
Well, they wondered about the skew and looking at the skew and you know, the IV.
Yeah. So one quick way to do it is we use these benchmarks here, and here's like the risk reversal right now. And this, what the risk reversal is doing, we talked about it a little bit yesterday. It's really kind of measures the skew because it will, this benchmark, what it's doing is going to a 30-day constant maturity, and you could go, you know, I think we have like 90 days and 120 days. So I'm just on the risk reversal right now. We'll stick with the 30-day. See, we have 60 days, 90 days going out, but let's look at a 30-day constant maturity. So this is like an option that has 30 days to expire. We're looking at a 5% out of the money call and a 5% out of the money put, right? And we're saying, well, if we bought the 5% out of the money call and sold the 5% out of the money put, how much would that cost us? So if it's a debit, it's going to cost you money. If you're receiving money, you're receiving a credit. In other words, you know, if you're buying an out of the money call for $1, selling out of the money put for $2, you're receiving that $1. So you're receiving a credit. A debit would be the opposite. So here, what it's saying is, as of yesterday's close, that the benchmark right now is you would receive 0.7% credit. That compares to a 52-week average of negative 0.6. So based on that, you're receiving a little bit more than you would have in the last 52 weeks on average. So this is what this is saying here. Here's what this chart would look like. So you're buying a 5% out of the money call. That's this B. If the stock goes above that at expiration, it acts like stock. So it just keeps moving up 1 for 1 at expiration like it is for stock. If it goes below that 5% put, it breaks through then you're getting the stock put to you. So you're losing 1 for 1, like you own the stock, right? You short that put, it breaks through that strike at expiration. It's a $100 put or delta 1-for-1 for stock. This gray area here, that's where both of these options will expire worthless. So it depends what you did. If you paid a debit, you would lose whatever you paid for. If you receive a credit, like you did in this situation, 0.7%, they expire worthless, you keep that credit. So that's what this gray area is over here. So let's just take a look. Let's set that up in the options chain. I'm gonna go, let's see what's close to 30. Got to go all the way out here. All right, so this is 20 days till 20 trading days left till expiration. So let's see if we set that up here. You know, so this would be like a 5% out of the money call right here. So this is the closest one. We're buying that. Then let's do a 5% out of the money put. So here's 305, you're selling that. So see here, I'm going to run that strategy. And what this is telling us, if we're buying the upside call, selling that downside put 5% around, we would receive a credit of $2.61 because we're buying the call $1.92, selling the 305 put $4.53. That's a net credit to us of $2.61. Let's just, here's the market 261, 264, midpoint 260. Sorry, midpoint 264. Remember, you're always trying to get it as close to the midpoint. The further away you sell it away from the midpoint, it's kind of like your fee to trade, right? So that midpoint is kind of considered the market fair value. But this is what it looks like at expiration. So if the stock expires anywhere here in between 305 to 337, so anywhere in this green range over here, then you just keep that $2.61 credit because both of these will expire worthless, but of course you receive 261 credit. So that's what you would keep in this range, right? It breaks above your long strike, 337 to the upside, you're making, you're just making unlimited, just like you own the stock. If it breaks below your strike, the 305, right, you start losing, you did get 261, so you have a little bit of money, that you collected here. But as it's going below that strike, it's like you own SPY at that point, and you're losing 1-for-1. So that's what the risk reversal will look like. But that's, as you can see here, 305 put, the implied volatility is 25.9. The 337 put, the implied volatility is 16.5. That's what we're talking about, the skew. The implied volatility in the call is lower relative to the implied volatility in the put. And as we saw from our benchmark, that skew it's close to the average, but a little bit, if you're doing this side of the trade, it's a little bit more favorable. All right, well, I have one more minute if you have a quick question.
Yeah, just last question. Jake just wants to know when the numbers actually refresh in the AM after the opening.
The market data? Yeah. So the market data, it's on a 15-minute delay. So that we don't get the market data until 9:45, from the 9:30, that's a 15-minute delay. Of course, once the market data comes in, they go through a process because you have to put them in a database, crunch the numbers, create the reports. So that could add a couple more minutes. So a couple, depending on the report, and there's like an initiation in the morning. So the mornings take a little bit longer because you're creating those tables for the morning. So it'll be after 9:45.
Awesome. Another great show, D. Thanks for piling in with the questions, everyone, on the YouTube chat. We'll try to get to some of those flowing in right now. Tomorrow, another great show. Hey, D, you did a great job. Thank you very much.
Thanks, everyone. Thanks for joining us. Have a great trading day and hope to see you tomorrow.
Have a great day, everyone. Stay safe. Trade smart. Bye.
Bye, everyone.